Government policies. Government policies is yet another factor, or I would say determinant of supply. There are different types of government policies government applies. Starting with taxation policies, you have subsidies, you have industrial policies, and many other regulatory rules. These government policies actually affect in two ways. If these policies are favorable, then it encourages the supply. If these policies are unfavorable, then it eventually decreases the supply of the commodity. I'll give you an example. Let's say every year I earn around 10 lakhs rupees. So out of which I pay a tax of 10%, which is 1 lakh rupees. So what happens if the tax rate has increased from 10% to 20%? Now I'll give government 2 lakh rupees. So the amount of money I have left for production will be less. So which affects my production level, and automatically as the tax rate increases, my production level decreases, and hence my supply decreases. So in this case, as the income tax has increased, what it affects, it reduces my supply. So in this case, this government policy of taxation is unfavorable, which discourages us, which reduces the supply. Let's say government gives subsidy for tax in SEZ, special economic zones. So what has happened? Earlier, when I was spending around 30% or let's say 20% of my taxes, now when I spend only 10% of my taxes, that extra 10% money I'll use in production of extra commodities. As I increase my production, automatically what happens? My supply increases. So in nutshell summary, what do I understand? The government policies, if they are favorable, enhances the supply. Government policies like taxation policies, subsidies, industrial policies, if they are unfavorable, they reduces the supply.